Yeah, yeah. What they saying? I'm so divine, I'm so divine. Imperfection, perfection, my presence shines. My mental is parasailing maritime. They say I'm destined to read the palm line. Yeah, I'm so divine, I'm so divine. Imperfection, perfection, my presence shines. My mental is parasailing maritime. They say I'm destined to read the palm line. Yeah, I'm so divine.
Welcome to the H.G.R.G podcast. It's episode 21. How you guys doing? We got a special guest today. All right. We have an asset protection specialist, also a broker as well, under all that umbrella. And like we said, guys, we bring you guys a lot of education. We dropped a lot of facts, a lot of gems for you. And we want to keep bringing people to the show that can give you a little more than what we can give you. We specialize in some areas, and there's other people that specialize in other areas that may be able to help you with what we do here. So I just want to introduce Justin. Justin, welcome. We appreciate you. How you doing today?
Welcome, Justin. Welcome, Justin.
Salute, brother. Salute.
Thanks for having to the podcast. Lance, you still with us?
Listen, another day, another dollar.
Hey, he brought in pen and paper today. So
another day, I'm taking notes and everything now. He's taking my job from me. So, once again, Justin, on this platform, I know you've seen this before and you've heard of us before, obviously. We teach people about the real estate side of things and, things they may not know, what they might not know, the good, the bad, the ugly. And there's something that you can offer. We had a conversation with you. And then you were like, wait, you could borrow against yourself? You could be your own bank. And I'm like, we got to have you. We got to have you, so we have questions for you. We definitely want to run through a few questions and maybe you can educate people on how to use, or utilize their insurance as a tool in real estate.
Give us a little background on you. Tell us what you do, what are you seasoned on, and tell us your background in insurance and everything across the board, life insurance and stuff like that.
Yep. So, guys, first of all, I appreciate you guys for having me on the course. This, awesome opportunity to be here to speak on the platform to the audience. But, like Lance said, guys, my name is Justin Pinkston. I've been in the industry. I want to say going on about 7 years now, and got started in the financial service industry back in 2003. And so it was just, never really. I would say it was a bit of a journey to get to this point, to where just being a broker and a asset protection specialist. But one of the things that I've learned over my years of being in the industry is that you just don't know what you don't know, right? And so people specialize in things that they specialize in. But a lot of times, still, you just don't know what you don't know. And so I started off in life insurance, which I'm still in life insurance, just different areas. I started off in what you would call final expense, which is, I guess, the more unattractive area of life insurance. Everybody needs life insurance, but, this is like I will say the underserved market, if you will. The people who are, on fixed expense, or their assets, I would say anywhere from $30,000 to $50,000 a year, on Medicare, Social Security, something like that, right? So I started there.
So let me ask you, so is that like just enough to bury you type of life insurance?
Exactly like you burial policies, right? So you see like. Used to be like Alex Trebek and, Colonial Penn, those type of, policy like that. So I started there, and it was good. Life was good for a minute. But, when I got licensed, because I'm licensed here in Virginia, and when you get licensed in Virginia, there's something called annuities. You get licensed for life and annuities, right? And I never knew what this annuity thing was, right? I knew I had I was licensed to do it, but I really never knew what it was. And so when I branched into finding out more about the annuity side, I found out also about this thing called self-banking, right? And so that's a little bit about what we'll get into tonight, but just an awesome concept, and we'll explore a little bit more about that.
Lance, don't do that again.
That's what we talking about.
Lance, don't do that again.
That's what I'm excited about. That's what I'm talking about.
Technically, what I do right now, I do help, protect people's assets. My client base right now is anywhere from, I sit down with people who have anywhere from 100,000 in assets all the way up to $20 million in assets. And so, but everybody needs your assets protected, right?
Can I ask you a question real quick?
Yes,
what does that mean when you have 100,000 or $20 million in assets?
So it could mean a variety of different things. Just depends on where the money is, right? And so, a lot of times people, have a lot of risk, and they need to know how to protect themselves against risk. So how to mitigate their risk. So we show people how to do that. And so life insurance, believe it or not, is one of those things that we use to do that.
So if somebody says I have, because most people, not most people, but let me speak for myself. From where I come from, if you tell me I got $100,000 in assets, I'm rich.
Right.
From what people so, but if you have a conversation with some of those people, you be like, I got 100,000 in assets. They're gonna be like, okay, because they don't know. They don't know they don't even know what the asset is. So that's why I, to me, to my people, I like to dumb it down because a lot of my people watch this. When you say you have 100,000 in assets, let's say I own two properties that are worth, 80, 90 grand a piece, does that add to what I have in assets, or is it just like a car, or is it like my retirement? Is it my 401k? What's an asset?
No, so absolutely. So all of that contributes to the overall number, but we do like to break it down because, it's, you have the house, so your primary residence, of course, and then investment property. So we like to break it all down. So what you have liquid, what you have in real estate, what you have, investment property. So all of that, of course, makes it all together, but we like to break it down.
Okay, cool.
So this is a real estate podcast. So I want to know how insurance can help you with real estate. Could that be a tool? Can you borrow against your insurance? Can you get an insurance policy where you can borrow against it, use that, and then buy real estate with it? Is that a possibility?
All right, so perfect. So the answer to your question is yes, but it's I would say it's twofold, right? And so let me ask you this question, right? In between, let's say deals, right? Most real estate investors, put their money somewhere. They typically put it where? In between deals and from.
Well, we hope not the bank, but
that's mostly where they put it though.
That's where they put it is the bank.
You really got me. How many options do you have? That off the top of my head, I'm sure you're probably going to introduce us to a new one, but for people who don't know that one, your options are bank, shoebox, or some type of maybe little small CD or something like that.
Right. And that's basically what we're taught. I mean, if you look at the banks have done a phenomenal job with marketing and making us believe that we need them in every aspect of life, right? Even when it comes to investing and purchasing real estate, purchasing assets, right? But really, the truth is, you can actually. So let me ask you this, because this is very important, right? What does the bank do with your money when it's in the bank?
Lend it out.
They loan it out, baby.
And that loan buys real estate with somebody else's money.
Correct. Now, here's a magic question right here. Here's a magic question. The bank, okay, when you get a bank account, it's the bank says $250,000 is covered.
It's insured. Yeah.
Who's it covered by?
FDIC.
FDIC. Well, who's the FDIC?
The federal.
Listen, you're not gonna stump us on our own podcast.
No.
You're not gonna come up here and do that.
No. Let's just say this: nobody knows who the FDIC is, right?
They say it's something to do with the guarantee on your money, which is supposed to be something that protects the dollar, and they're the ones that, if I'm not mistaken, that they kind of stamp and solidify the printing of more money, the value of the American dollar, if you will.
Yo, Lance, quick, Google that.
Right.
I'm sorry, go ahead.
Pause the podcast.
Time out.
So the short answer to that question is the FDIC is the insurance company, right? So if you looked at the bank's balance sheets, which nobody ever sees, the banks are heavily invested in insurance companies, right? And the reason is because they get the insurance companies. When you think about 2008, you think about 2000, insurance companies never need a bailout. They never, ever need a bailout, right? And why is that? Well, because they're some of the richest companies in the world, right? Insurance companies are. And so the banks are heavily invested in insurance companies, right? And so what we have to understand is that the banks are dealing directly with the insurance companies. But we are taught, we're conditioned to only think of insurance as really having one use, and that's basically when we die, is to pay benefit when we die. But that's not the only benefit. And so there's something called living benefits, right?
Ooh, that's that talk, guys. That living insurance. I love it.
Absolutely. So we actually have living benefits with insurance, guys, and it comes in the form of self-banking. So now this is where when you start to level up, right? You get, you have different, you're not just dealing with an insurance agent, right? You're dealing with an asset protection specialist. It's the same person, but they have a different title.
Let me speak to your manager. I am the manager. Yeah, that's basically what it is.
Be like, please hold.
Right. Just depending on the client who I'm talking to. If you're under this amount of assets, then you're just an insurance agent, right? If you're over here, then you're talking to an asset protection specialist. So, but to answer your question, here's the thing, right? When you look at what we do in between deals as an insurance, as an real estate investor, right? We typically hold our funds in the bank, right? Well, we know what the bank is doing with that money. The bank is lending it out. It's invested in, it's giving out loans, real estate, mortgages, whatever the case may be. But we're still right. We're still at little to no interest on that money. Okay. Now, what we teach is this, okay? Why not actually take that money, okay, and purchase yourself an insurance policy, okay? Why would we do that? Well, number one, not just any type of insurance policy, specifically a whole life insurance policy or an index universal life policy.
Okay, let me stop you for a second. What do you say whole life insurance? Is it half life insurance? I mean, what do you mean by whole life?
Right. So typically there's generally two types of insurance, right? You have term life, right? Which means it terminates at a certain point, or it's only valid for a certain year or a certain number of time, right? And then it terminates. Okay. Whole life is basically, it sounds just what it is. It's for your whole life. And so if you have to look at term versus whole life, it's like renting versus owning, right? When you rent, you pay all this money and you don't get never get to own it, right? But when you own it, right, you pay a mortgage, and then what happens? You build something called what?
Equity.
Right?
Oh, he's trying to teach us something. You ain't gonna do that to us.
Yeah, everybody comes over here trying to take somebody's job, right? Go ahead, man. Go ahead, continue. This is important.
I'll just get real estate terms for the audience. But, so the whole life is equivalent to basically owning, right? Because what happens is, just like the equity you build in a house, you build cash value in a whole life insurance policy. Okay. Now that cash value, depending on your premium and how much your premium is how much you're paying on a monthly annual basis is going to determine how much cash value you build up in that policy. Does that make sense?
Yeah.
1000%.
Okay. And so so that's the two the two different policies you'll see. Now, there are different types of whole life policies, right? You have a variable life, right? Variable universal life, excuse me. And then you have an index universal life. Okay. And so those are typically what we really what we use in terms of investing investing in ourselves to be able to do better than what the banks are doing for us.
So I have term right now that I'm learning about this, because I know it's a 10-year term.
Right. Okay.
I've had it for like 6 years now.
Okay.
And I can't do anything with it. I can't borrow against that. I can't do it. It just is what it is, right? After, in a few years, they're going to try to give me another 10-year term, and that's that. But I can't utilize that in any way for myself, correct?
Right. So a term policy is good for certain things. Again, I always tell people, if it's nothing wrong with term, right? You have terms that will give you a return of the premium that you paid for the entire lifetime of the policy. So it's a term with a return of premium. So imagine if you're paying $100 or $50 a month, and at the end of that term, 20-year, 30-year term, nothing happens. Well, you get all that premium back. That's awesome, right? It's a little bit more expensive, but that's the type of term that's out there as well. Now, you also have convertible term policies. Convertible term means, let's say at the end of my 10 years, or at 10 years in your case, you want to convert that over into a whole life coverage, right? There's some policies that allow you to do that. Okay.
When you do that, does the equity goes with it?
A portion of that does go with it, yes.
Okay.
Yeah, a portion of it does go with it. So really just depending on the policy. But overall, when you think about term is really, I like to say, for in the beginning, it's for people. If you think about the stages of life that you go through, in the beginning, let's say when you're younger, you're growing a family, you have the house, the cars, all of this stuff that you have to pay for, right? A bigger term policy is ideal, right? Because should something happen to you or your spouse, you want them to be covered. You want your kids to be able to have the best chance for education, so on and so forth. So you get these bigger policies, but the premium, is not that big, right? And so that's the ideal for term. And so let's say you have a 20-year term. By the time your kids are grown, they're in high school, they're in college, the house is paid off, the cars are paid off. There's not really a need for that term anymore. Does that make sense?
Yeah.
For that type of policy. And so, some people
I don't think my house will ever be paid off.
That's a fact.
My bad.
No, you good. Now, I love that you said that, because some people still do keep term policies, right? And I'm a big believer still in keeping term policies, because just the ability to have that amount of protection, say that anything happens, right? It's there, right? And so, but that's not where the protection should stop. Insurance is not a one size fit all, because I get this question all the time too. Is there a limit to how many policies I can set up? There's absolutely no limit to how many policies you can have. You can have as many policies that you can pay for, right? So some clients I have, they set up policies certain for specific things, right? I have some clients that set up policies just for estate tax planning, right? And so the average person won't have this issue, because maybe they don't have, federal estate taxes start at 11. I think they bumped it up to $12 million this year. So meaning, if my assets run into, this is a problem that we all want to have, right? So,
right.
1000%.
My assets get to 12 million, then I'm going to have a problem, but it's going to be a good problem to have, right? And so,
can we talk about that? Me and you off screen tomorrow about that?
Absolutely.
Absolutely, right. And so, so getting back to the question, because I don't want to go down the rabbit hole too far here, but ideally, when we use an insurance policy as opposed to the bank, we're now able to take that money, put it into a policy, and get paid what I would like to call dividends. It's not actually dividends, but it's just interest, right? We get paid a certain amount of interest on that amount that we put in, right? And that's annually. And so as opposed to getting zero to next to nothing that the banks will give us for holding that same amount of money, we now get paid interest on it.
What's that interest usually look like?
Yeah, but you know I was gonna ask that question.
I know. All right, I got you. I'm the host. I got you. I saw you were going. I jumped.
So
I got a Jerry question next. If he don't ask it, I'm gonna ask him it next. If he don't ask it.
Well, I got 2 part question coming up. So go ahead.
Oh, part 3.
So on average, it's about 6%, right? So on average, it's about 6%. So you're not going to get rich. However, you know, if you look at that over the stretch,
over the banks, you're rich.
It's a no-brainer. It's a no-brainer.
Absolutely.
It's a no-brainer. You know. So,
so my 2-part question will be: would you be able to take out the money any given time? And then when you put it back, do you have limits on when do you have to take it out? So if you put it back on February 3rd, can you borrow right back at February 15th? Does it take some time?
Good question. So so basically there is a period depending on how much you put in. Meaning, let's say if
that's what I was gonna get to, if you don't mind, Justin, before and Jerry, because I just don't want to go. Because I'm trying to pay attention. I'm trying to go along. And you guys probably have a lot more understanding of this because you've had several conversations with this gentleman. I haven't. Right?
Or we're just a little more advanced. I mean, it's no big deal.
Or you guys might be, 3/4 cup full and I might be 3/4 empty. I mean, I don't know.
No, go ahead, Papa.
I'm trying to follow. So I just want to if you can create like a real life analogy, right? Sure. So let's go back to the point where you said, what do you do typically when you do a real estate deal? You take your money out of the deal or you cash out of a deal. You normally park it in the bank or whatever, right? Okay, so now we're at that spot. Let's use a real number. Let's say I get a property that I sell or whatever, and I come out with easy math, $100,000. Right? I got $100,000 that I just cashed out of this property. I normally I would just put it back in the bank and wait for my next deal or whatever that will look like. Okay, so now take it from there and create me a real analogy based off those numbers, and then obviously you could pigtail right into what Jerry said, but just based off those numbers, so it hit home for me.
Right. Okay.
Please and thank you.
Let's take that 100,000 just as a real real deal. And it's funny because I had an actual illustration that I would have showed you guys tonight. But 100,000. So typically, of course, we will put that in the bank. Now, in this scenario, we would open up an IUL, right? An Index Universal Life Policy. Okay. Now, that IUL is going to pay us 6%, okay, minimum 6% annually on that 100,000, which is only $6,000, but it's $6,000, right?
Mm-hmm.
Now, to that question, I think Jerry asked, how can I borrow from it?
Mm-hmm.
And how often can I borrow from it, right? Well, once you make that lump sum deposit into your account, right, into setting up that policy, typically within 3 months, okay, you can actually borrow from that policy, okay, and you can borrow up to about 80% of it within the first year, okay, within the first 3 months.
So 3 months. I just want to be clear. I want to go step by step here. 3 months. He puts his 100,000 in. 3 months later, he can take out 80,000. Has any interest built at this time? Where maybe he can take out $80,000 and $3. You know what I'm saying? I mean, just want to know. And why I asked that, I know I'm being funny, but I'm not. I just want to know if any interest that's building can he pull that out as well? Or, is it because at 80%, 100,000 may be a little more than 100,000 now with interest. And that means the 80% he could pull out is just a little more. So is that a possibility?
So no. So typically is credited on the policy's anniversary date.
Okay.
Interest is going to be credited.
I listened real well. So when you said annually, I already knew that was the answer.
Right.
For sure.
So he said, so now you're trying to be more advanced. And that's
now you are 3/4 empty and I'm 3/4 full. You know?
No, hold on 1 second. He said 6% at the annually, right? At the end of the year. It doesn't mean it's not building up interest throughout the year.
That's how you heard it. I heard it.
I might be wrong here, so let's move on really quick before anybody catches on. All right, let's move on really quick.
Justin, this is what I deal with on a regular basis. Right.
Let's move on really quick. So, all right. So obviously the answer is no.
That's a good question. That's a great question.
Yeah.
So the answer is no, right? So 6,000 you'll get. It's annually. It's at the end.
Anniversary date.
Right.
And as your anniversary of the insurance that started. Anniversary date. And so it would be 80,000 he can pull out after 3 months. Plain simple.
Up to correct.
Up to 80%. Which
so you take out the 80,000. You utilize that, and that's the most you could take out in that year. So that 20,000 has to sit. You will continue to accrue that 6% on that 20,000, and you'll receive that on the anniversary, or no?
Absolutely not. You get your accrue on 500,000. 1,000%.
On 500,000.
No, on the 100,000.
On 100,000. Oh, I thought I heard 5,000. My camera's messing up to.
Come on, brother. Come on. Yeah, we would still get money. we would still get interest on the 100,000.
100.
Is that true?
That's absolutely true, and that's one of the best kept secrets is that people don't understand that. Basically, we're not actually moving the money, right? As one would think. We're actually taking a loan out against the policy. So the money never goes anywhere, right? We're actually taking a loan out against the policy. And so that's the beauty part of it, because now we're utilizing the insurance company's money to make more money for us. So now that's where the concept of self-banking comes from, right? Because it's my policy, it's my money, right?
It's my loan.
I'm funding my own project.
And I want my money now. That's it.
It's my money and I want it now.
I want it now.
I couldn't help it. But so, man, because I always hear it, but I don't know the research, right?
This is going to be good, guys. This is going to be good. This is good.
Great information.
So there is, I always like to say there are some caveats in there. Of course, depending, you don't want to do everything with the same policy, meaning that, there are MEC laws. You also want to have people, an agent that's experienced with doing these type of policies, because, an insurance agent per se, their job or goal is to, is to write a policy or create a policy and earn a commission, right? If you're not really understanding, how to set up or how to design these specific policies, what can happen is you can set up more death benefit than really what the policy is really designed to do. So meaning when we create these type of policies for self-banking, we're not really worried about the death benefit. That's not what this is designed for, right? So what we do is we overfund these types of policies, right? It's all about how much cash value we can build in these policies, right? And so a novice or inexperienced agent, they would say, hey, I can, it's just an IUL, right? I can follow the steps, and now you got this massive death benefit, of I don't know, whatever it is, and it's really not,
So what you're saying is, in life insurance for death is more more lucrative for the agent instead of being a whole life insurance, is what you're saying.
Correct. Because on a policy, and I'm just giving you the sauce, a policy that the agent gets paid on the target premium of the policy, right? And so
now we're talking. Now I'm learning.
Yeah,
go ahead.
Death benefit.
You were learning before. Just stop putting the game face on.
The bigger the death benefit, the bigger target premium, and they pay you off the difference of whichever is lower between the two. The insurance agency pays the agent, and so when you understand really what the client is trying to do, you want to minimize the fees, right? And you want to make sure that you're not that the client is not overpaying for something that they really don't need. So we don't want you paying for life insurance because you may have a term policy and you're good there, but this is really just used as a vehicle to house your money for the next investment deal that you're looking to do,
and keep that 6%.
And keep that 6%. Exactly.
I mean, that's key to me. I mean,
that's golden.
So here's the thing. So let's stay with the scenario, right?
I was. Go ahead.
So DT, I'm excited for this one. So DT takes out the 80,000. Right. You said it's a loan.
It's a loan.
With a loan comes payments. Comes interest.
Mm-hmm.
What does that look like?
So typically, you do have a set loan term, okay, and that interest is average about 5% on the loan that you'll pay back, and that's over a period of time. So whatever the conditions are of the loan. Now,
what's the typical time a loan is?
It can be 5 years. It could be 10 years. Okay.
Beautiful.
So, that's, again, another favorable condition of dealing with your insurance policy.
That's like a car loan.
It's amazing.
Man, this is changing everything for me. I mean, if I want to fix up a whole property, I take 30,000 from my life insurance, no problem. It's like it never left. Still get my 6% on that. At the end of the year, if I take out 30,000 and I have 200 in there, with my annual percentage that I get from it, my annual interest that I get from it, I can pay it back. You know what I'm saying? Or I'm earning it back.
Correct.
I mean,
now here's the thing, right? Depending on, let's say you're not utilizing this policy for retirement, or you're not, it's not something that you're not looking to retire from, right? Let's say, you know what, Justin, I don't want to pay back the loan, right? Well, what happens is that loan amount is now deducted from your death benefit. Okay. So let's say if I take out 20,000, right? And my initial death benefit when I started the policy was 150,000, right? I take out 20,000 or 50,000, let's just use 50,000 in this case, right? But I don't want to pay the loan back. Well, they just deduct it from my death benefit, right? So instead of when I die, my beneficiary get 120,000, they just get 50,000 less, right? But my whole intention wasn't for the
death anyway.
For the death penalty, right, exactly.
I got the $1 million question right now. What does the IRS tell me when I take and put back?
So the IRS actually, so that's funny that you mentioned that. So the IRS actually created these laws, right? Or actually, so there's something called the TEFRA, the DEFRA, is one other law called the TAMRA, right? And so basically what happens is they have a last in, first out, first in, last out. And that basically means how you fund these type of policies. So back in the day, these policies used to, I mean, you could really you could really do phenomenal with these type of policies, right? But then of course the IRS stepped in. Anything that we start doing too well with, they'll find a way to kind of like,
I want in.
yeah, they'll say, nah,
Or regulate it.
yeah, y'all doing a little too well with this. We're gonna have to put a cap on it, right?
Right.
And so they've done that in the past, but the IRS, does still make it favorable for you. So there are some major tax advantages, of course, for doing this as well, because you decrease your tax liability when you invest in insurance. So I'll give an example. So most people are familiar with capital gains or dividends or
guys, you should know capital gains by now. If you're watching us, you should know what capital gains is. Go ahead. I'm sorry.
Right.
My apologies.
So no, that's good. So you're taxed on those, right? You got to pay taxes on capital gains tax. You taxed on dividends that you get from your stock returns. You taxed on interest, right? Well, there's one thing that you're not taxed on, right? There's one, maybe more than one thing, but there's one thing in particular that you're not taxed on. You're not taxed on profits that you get from insurance, right? You're not taxed on insurance profits.
So it's not taxable.
It's not taxable, right? So that
That's the $1 million question right there. I don't care what anyone else said. Everything else is over with.
that's 6,000. Now imagine. Let's 10x the 100,000.
Right, exactly.
Right. 10x the 100,000, and 10x the 6,000. Right.
Yeah, yes.
So that's
$60,000 a year, clean, no problem.
That's clean.
That's it.
So a lot of people, what they will do, they'll run up the bag because they know they can live off, the dividend off the insurance policy.
What's the cap?
What's the cap?
What's the cap? Because I'll tell you right, if I hit the lottery,
right.
why not park, 10 million,
yeah,
20 million into something like this and live off of, the go ahead. Sorry.
Well, there is no cap, right? And so you got to think about the insurance industry as a multi.
I can't believe he just said that.
He just said that clear. Yeah, I think. Hold on, we need to cancel this.
I can't believe
we can't put this information out.
This
coming for us,
man. Nothing like this, man. You can't
listen. The CIA is gonna knock on the door and be listen. We need that podcast.
I'm sorry, we got to end this podcast now because.
Justin, did you get all that? Did you guys get all that?
That is crazy. So why is it? Because you said that the IRS comes in, they want to regulate things, so why wouldn't they cap something like that?
So they have capped it in the sense of how you can pull out the funds or the amount that you're taxed on, meaning or when you're taxed on, I should say, right? So they have something that's called basically when you put the funds in, right, that's called your initial premium, right? And so anything that you take out, right, that's also considered, guess what, your initial premium. So you can't be taxed on that.
Right, on your initial premium. You can't be taxed on the money that you put in that you're taking out. That's initial premium. Right.
Correct.
All
now,
right.
anything over that, again, is still considered insurance profits, and you're not taxed on that either. But here's what we do. When we take the money out, guess what we take it out as? We take it out as a loan.
That's right. So you can't tax a loan.
You can't tax a loan.
You can't tax a loan. I tell you, this is crazy. So I don't want to lose this.
Yeah. Hold on. I want to go back to the scenario.
So do I. So go ahead.
After the first year, you can only take out 80%.
Right.
Let's say January 15th, I put in the 80,000 back. What are my limitations after that?
What are your limitations? Meaning how much can you withdraw?
Because you remember his policy started February 3rd. So he's saying January he puts everything back in. Now it's the second year. What does that look like?
Yeah. How can I frequently touch my money? How can I take out? What is the limits? What is it the same yearly compensation, or every 3 months now I could flip my money?
So no, you'll be able to take out. So once it registers that you paid back the loan, you can now take out. So within that second year, you should be able to access almost 100% of what you put in.
What are we doing?
Yeah.
What are we doing?
What are we doing?
So after your initial investment of the 100,000 you put in, you borrow the 80, you got 5, depending on what policy you got or what plan or however you borrow, you got 5 to 10 years to pay it back, right? There's you said about 5% is the interest rate for that, right?
Correct.
Where does that interest go? Who do you pay that interest to?
So that interest is basically paid to the insurance company, right? For basically, borrowing against the policy.
That's a great question. Actually, that's a really good question. So I want to stick on the scenario because yes, I'm going to say,
yeah, because I've heard before, not to cut you off, because I've heard before people say, and I know sometimes it just kind of convolute information. You could borrow against your insurance policy and you pay yourself in interest.
It essentially they say that is because you're paying it all to one place. Mm-hmm. It's going back to you essentially, but it's fees that you're paying, right? And so in which you're paying back, it's a fee that's assessed on your policy, mm-hmm. right? Just to make sure that you're keeping up with the growth or the anticipated growth of the illustration in the policy, but it's a fee assessed by the insurance company on your policy. So I just like to keep it 100. You know what I'm saying?
Yeah. So in the large scheme of things, right? You got 100K invested into an insurance policy, right? You're putting it in the hands of somebody who's going to allow you to borrow from that, allow you to continue to accrue interest on that as you're borrowing it, but you're also paying interest on it. So kind of sort of cancels out for that moment, but that 6% doesn't stop.
Correct.
Right?
Exactly. And then again, when you think about the term that you have to pay that back, mm-hmm. it still works out.
Yeah, because if you borrow 100, if you have 100K and you borrow the same example, the 80K over 5 years, right? That's the 5-year loan. You've accrued 6% on the initial 100K over the course of 5 years, which is 30K. So now your 100K is now 130, and you've paid the 5%. They didn't take the 5% out of your entire 130.
Right.
You know what I mean? So it's growing. It's growing that way. Gotcha.
And so you're able to take the money and fund, future deals where you were able to, basically supersede that anyway.
Gotcha. So I want to get back to I want to stick on this. I don't want to leave this because you said something that, my antennas went up. I don't want to pay this loan back. Right. So if I owe and then I die, then they'll take it out of, what like, let's say you said 150,000 of my death benefits. They take it out of there, or do I just tell you now while I'm alive, like, hey, listen, I took this 80,000, I'm not paying it back. So you could just take it out of my death, my death. Is that how that goes? Or, I mean, can I just tell the insurance company, listen, kick rocks, you could just take it out of my death benefits when it's time?
Yeah, well, they'll actually let you know. So they'll say they'll give you a certain amount of time that you can make the payment to pay down, so that your illustration still stays on track. Now you can make the decision to make the payment or not. So if you don't make the payment or make the deadline to make the payment, then it will decrease your death benefit automatically.
Now let's say it's 50,000, right? The analogy you use, 50,000, I don't pay back. For whatever reason, I decide not to pay it back. The same analogy you used, my death benefit was 150,000. Now, when I die, it's only 100,000.
Right.
Is that really true? Or do they take, because you owed 50, there's fees because you didn't decide to pay it back on time? Is there like repercussions for that? Does my 50 now become 75 because of there's like an agreement, like a cancellation or lack of payment or whatever that the case may be? Is there something attached to that, or is it 50 just 50?
It's just 50. Yep. It's just 50. So that's the beautiful thing about it.
I don't understand it. I don't understand it. I'm trying to be very honest here. I mean, I
kind of get it. I kind of get it though, because
not that I don't really get it.
One thing we're not talking about, right?
Yeah, he's trying to sell the fans.
Yeah, one thing we're not talking about is that this. So I take this 100K and I put it into an account and I do all the things, the great, amazing things we just talked about, right? What we're not highlighting is what it's going to take to even be that type of person that has the access to that.
Right.
Can you highlight that? What does that look like? What type of policy? What type of plan? What type of financial
backing or
obligation?
Assets, yeah.
You know, what am I agreeing to if I was to even be something that would allow me to take part in something like that?
Meaning, you know, the type of net worth that you would have to
policy type, net worth, dollar amount. Because me listening to this is like, oh, this is a cheat code, right? And then some people are like, there's a catch. Some people are like, there's not, you know. But in me, just, you know, rationally thinking, I know that there's an entry, entry barrier, right? So what is that? So that way I'm not the guy who's in a position that can't take advantage of this and like super stoked and go have a conversation tomorrow and sound crazy.
Right.
You know what I mean?
The guy's like, I got 5,000
right.
and I'm gonna put it in there in 3 months. I'm gonna borrow 80% of that. You know what I mean? What is, like you said, what does it look like? You gotta be a big bowler.
Right. We all know that this doesn't apply for everybody.
Well, I mean, to be honest, it does apply for everybody. Now, depending on what your financial landscape looks like, you know, it's not, your situation may be a little bit different than the next person's, right? So meaning some people have to start off not with the lump sum, but just with the monthly premium, right? So let's say their monthly premium, you know, is $300, or let's just say $500 a month, right? Well, $500 a month for 12 months, that's, you know, $6,000.
Mm-hmm.
Okay. $6,000, they do that for 2 years, you know, they build up some cash value, right? Now they can start to access, you know, those funds. Does that make sense?
Yeah. So with that analogy, if it's, let's say it's $500 a month, $6,000 a year, I do this policy for 3 years. Mm-hmm. On paper, I've accrued $18,000 in 3 years, right? A couple questions.
Right.
What does a $500 policy look like?
So a $500 policy, depending on the person's age, their health.
I'm 40 years old. I'm in good health. I don't go to the hospital because I don't have any health issues. Thank God. I'm overweight, but I'm pleasantly overweight.
He's just plump.
You know what I'm saying? But aside from that, thank God I have a clean bill of health.
Yeah. Yeah. So that's going to look like something. Now, if we're designing it again, to overfund, and we're not worried about the death benefit per se. Mm-hmm. So we're going to minimize the death benefit. We're going to get the minimum amount of insurance that we can possibly get.
Okay.
So it may be $100,000.
Sorry to cut you off, just you're telling me I could also buy a benefit, separate death benefit insurance, correct? And then do this.
Right. So okay. So exactly. So you're going to have two, let's say you can have two separate policies. So let's say you got your term policy over here that's just covering you in the event that something happens to you.
Which is always recommended.
Which is Correct. Always recommended, absolutely, by far, right? But also over here, you have, you know, this type of policy, which is basically
IUL, right?
Right. And
this is a whole life policy.
This is a type of whole life policy, right?
Yeah.
And for this, you know, we're really not worried about the death benefit. So we're going to have the premium that we pay. Let's say it's $500 in this case. Maybe 100, 150 of it is used to purchase that $100,000 worth of death benefit.
Gotcha.
But the other 350 is overfunding. We're overfunding the policy to create cash value in it faster.
Okay. Yep. So that's what my $500 policy looks like for the next 3 years. Now I accrue $18K, which 150 of it was towards the death benefit. So essentially, out of that $6K, I'm probably looking at like $4,000, $4,500 a year that was actual overfunding, right? So does my cash accrual only come from that 450?
No, your cash value is going to come for the full premium.
Okay.
Right?
Okay.
Come from the full.
It's nuts.
It's the total.
Everything benefits you. Sorry, go ahead.
Right.
So after 3 years, the total $18K. How much is it? So
it's not $18K though.
That's my question is, after 3 years, I have $18K that I've paid, right?
Okay.
That I've paid. So now after 3 years, if I wanted to tap into that benefit, how much is available to me, and what does that look like?
So on these policies, I would say minimum after 3 years, about 80%, right? And again, it's only because you're not coming with a lump sum like you would in the other scenario.
Yep.
Right. So when you're accumulating, you're building like that, and that's why I said it really doesn't matter, depending on where you are.
It's very similar to 401k.
Yeah, it works for all levels.
Are you familiar with that?
Absolutely. Mm-hmm.
Right. It's very similar to 401k. When I had a 9 to 5, I did this with my 401k.
But the 401k though is based on the market.
Right. So the difference with the 401k is the 401k is, of course, you have to be 59 and a half to be able to tap into that without penalty. Right. Also,
mine was a little bit different, and I was able to tap into it.
You can only borrow about 60% from it.
Yeah. So that the difference is, well, let's be clear. When I borrowed from it, I don't know. I just asked them, can I borrow? They were like, yeah, they told me the number. This
is why we got Justin here.
100% clear, right? Yeah, 100% clear. I say, yo, because somebody told me, yo, you could borrow from your I was like, really? I called the number. They told me how much is available. I said, let me get all that.
Right. Exactly.
That's all that happened. It might
no penalty?
Nah.
No, there's no problem. But he has to pay it every month, every week.
I had to pay it back. Well, what happened was I ended up leaving my job before I paid it all back.
You got taxed after that?
I didn't get taxed. So what happened was, so just to make it right, I had to send them a check for the full balance.
Correct.
Prior to me leaving my job, so that I'm in good standing, so that when I'm 59, to Justin's point, I can collect a retirement benefit from them of a dollar amount or whatever.
Gotcha.
Yeah.
Right. And so there are certain conditions, of course, that you can tap into it, the 401. There, as long as you pay it back, they'll, the company, they may suspend your ability to contribute, things like that. So it just really depends on the situation. But
let me ask you a question also. I'm sorry to cut you, Justin.
No problem.
So when you borrowed from the 401k, did you get any interest on the whole amount?
Remember when I said they tell you that you can borrow from it and you pay yourself interest. That's
Correct.
what they told me.
Okay.
But you don't. The fact of the matter is, you never pay yourself interest. You pay them interest.
1,000%. That's why I want to ask that question. Okay.
But that's why I said what I said to him, because that's what they told me, and I found out that was a lie. Because when they told me how much I owed back, I was like, "That's what I borrowed a year and a half ago."
Correct.
Right.
You know what I'm saying? It was literally the same dollar amount. I think it was like $7,000. So a year and a half went by. I was paying the payments. They just come straight out of my check. I didn't even. You don't ever see it. So now I ended up wanting to leave my job and retire or quit or whatever. And I was like, all right, what's the balance? What do I owe? The same 7 bands you borrowed.
Yeah, you know what you took? Yeah, bring that back.
This whole time was just interest only. We were going to charge you this for the next 10 years.
And once again, with this, the IUL, if you don't pay it back, they take it from your death benefits.
That's not an option in 401k.
Yeah,
this is wild.
I don't know. I don't think so.
My next question would be, is my money safe? So in the 401k conversation, if the market goes up and down, I get hit.
Right.
In the insurance company, what happens?
So when you think about an insurance company, right? And insurance companies are probably the safest place, the most safest place that you could put your money, right?
Not to cut you off, Justin. You heard what he said earlier, right? When they need a bailout, the insurance companies don't need it.
Right.
Well, see, I'm just so I'm listening, guys. Go ahead.
Right.
Sorry, Justin.
Right.
This guy.
You're supposed to be listening. It's your podcast.
He must be interviewing for jobs somewhere you work, or he must need something from you because this guy is acting different with you. I'm telling you.
I'm excited. I've been wanting to know about this for a long time, how to make my own bank, and so now I understand it.
I'm gonna be honest. They've been talking about this interview for a long time, and they've been telling me about a little bit about what you guys have talked about in the past, and I've always been like, man, listen, don't tell me, because and Lance has been the first one to be like, I don't want to mess this information up. I'm gonna let Justin tell you, but when this conversation comes up, it's gonna blow your mind, and I'm kind of soaking it all in. That's why I'm glad to just really I'm sitting back listening, because I just want to be like, okay, take it all and I want to ask sincere questions that people that listening would ask. You know what I mean?
Absolutely. But think about the insurance companies, right? So insurance companies, man, I have an insurance company that as a broker, of course, we're contracted with, a lot of companies, right? Companies that have been around since. I got one company that has literally insured Abraham Lincoln. Seriously.
What?
That's crazy.
Yeah. So that being said, right now, of course, they transition, they do name changes and things like that. But the history of this particular company, it's been around long enough, and it actually insured Abraham Lincoln. Okay. So I say that to say insurance companies, these are some of the companies that
I got a tenant named Abraham Lincoln. Talking about him? You talking about him, or you talking about the real the guy on the penny? My bad. I'm sorry.
But when you think about insurance company, they're some of the biggest companies in every major city you go to. They got the biggest buildings, right? Them and banks, of course. And then here's the thing: when you talk about safety, right? How safe is my money? Well, first of all, when we talk about an index universal life plan that we're talking about with the self-banking, this is attached. It's linked to the market, but it's not actually in the market. Okay. So meaning it's linked to the market, but my money is never actually in the market. So if the market goes south, right, I do what's called a flat line. Okay. Meaning my money just goes like this. I may not gain anything for that year, but I don't lose anything either. That makes sense?
Right.
All right. So that's one thing. Now, the other thing is this: insurance companies have the biggest.
Hold on. Let me ask you a question. You said I have a thing that's flatline.
Right.
Right. What does that mean? Like for me, as the person who has the policy, does that mean if I utilize you as my broker, you're going to set me up in a position where my funds would do that, just flatline?
He don't get a 6% at the end of the year?
Or does that mean that you're saying what you do personally?
No. So what I'm saying is, so your policy has the potential. So when I say 6%, 6% is just a minimum, right? An average minimum. Now you can get, I had clients that got 12% last year, right? That's because the market did what it did, right? But on average, 6% across the board, right? So what I'm saying is, let's say the market just takes a dump, right? Let's say your index universal life policy is linked to the S&P 500. That means however the S&P performs, that's how my policy will perform. Okay. Now let's say if it performs poorly, well, what happens is if it performs poorly, if my money was in a 401k, then when it performs poorly, my money goes down.
1,000%.
With this, if it performs poorly, my money doesn't go down. It just stays just like this. That makes sense.
What is that? Is that 6%?
Yeah. What's that number that stays like this?
Right. So 6% in average. That's why it averages out at 6%. So what we typically do we look at the last 20 years, right? The insurance company takes a scope and they say, you know what, based on, you know, year 2000 with the dot-com bomb, 2008, you know, with the Great Recession, right?
That was what I was gonna say. So what an anomaly happens. 2000 happens, 2008 happens, right? What does an anomaly number look like?
So that's what I'm saying. The anomaly looks like 6%. So
Wow.
they say,
What are we talking about?
Yeah.
We take the worst, you know, the worst 20 years in economic history, right? You had 2000, 2008, and then you had, you know, all of what's going on right now. They said in this 20-year stretch, you know, this is, you know, we had in 1 year in 2007, I believe, we dropped like 39%, something crazy like that, right? And so 39%, 2008, 2007, 2008, 39%. That's crazy, right? So
Yeah,
that's
a real jump.
that average over that 20-year span still average out to about a little over 7%. But we take 6% just to be conservative.
And we okay with the 6%, brother. Don't worry about it. Don't worry about it.
That is, I mean, listen, this was a lot of information. I tell you that. I mean, I've been dying to hear because I've you know, I'm a YouTube junkie and podcast junkie, and I've heard, you know, how to be your own bank and borrow against yourself. So I understood it a little, but now that you said it with the IUL, I mean, like now I really get it. I see what it can do for you, you know. And if you make millions and you're not doing this and parking your money here, you know, in real estate and here would be my two things. I mean, I couldn't see it any other way.
Yeah, this would be something that I would say that you would diversify your portfolio with.
Absolutely.
For me, right? You know, I'm not a 10 millionaire, but I'm a baby millionaire. You know what I mean? This would be something that I would consider to diversify the portfolio and maybe just try this a little bit, see what that looks like. Just to see a different aspect of it, you know what I mean? And figure that out. But to be clear, I don't think you have to be a millionaire to tap into something like this.
No, he gave you both sides, right? He said you can build it up as well.
Yeah,
I mean,
build
absolutely.
it up, you know what I mean? You could be, you know, a 9-to-5er with a respectable salary income, you know, 70, 60, 80 grand. You can afford $300 a month for a policy.
Absolutely. And honestly, you know, that's one of the things I teach is that, you know, most times people don't understand that they're that they're overpaying the government all throughout the year. Right. So, I mean, if you got a W-2, you know, and you don't understand, you know, how to fill out your W-4 correctly, 9 times out of 10, you know, you're overpaying the government. You're giving the government an interest-free loan all year round. And, you know, tax time come, you're getting a refund, you know what I'm saying, for your overpayment.
Right. And
what do people typically do with the refund? Well, they blow it. You know what I mean? They, you know.
They're doing it right now. It's tax season right now.
That's right.
I'm going to blow mine right now.
Tax season right now.
The average person say, hey, look, let's get this correction, this W-4 corrected. And let's take that $300 average and put it in somewhere where it can grow, right? You follow what I'm saying? So now it's going to give you, you know, the protection that you need. It's going to actually start, and you're not going to miss this money, you know.
You're already using the money anyway.
Actually,
they buying a bunch of Jordans anyway.
Correct. And so, you know, that's where the average person should start. The average person that is looking at this, they say, you know what, you know, I don't have, you know, 10, 20, 30 grand or whatever the situation is. Well, if you got a W-2 job and your W-4 isn't corrected, this is where you would start.
You said that a couple of times. What do you mean by that? How can my W-4 be incorrect?
So most people just don't know that, you know, how to fill out a W-4. And so
this is super important.
Yeah,
super important.
So you know, you got enrolled agents, you know, with the IRS, you know, your tax person, you know, they will actually tell you, hey, look, this is incorrect. right? And so I always defer.
H.G.R. block, I'll tell you that. Okay, my fault.
Yeah. Each of the block need to do it.
TurboTax.
That's a fact.
You know what I'm saying? So, but yeah, most people just need to have that conversation and make sure to get the W-4 filled out correctly. And then, they can typically I see when that happens, an average of anywhere $150 to $300 increase, per month in a person's paycheck. I had some people, man, $600 additional in their paycheck, for the month. And so, but
is this in reference to like claiming certain dependents and all that good stuff? Are you referring to that as well, or is it something totally different? Because I know I'm listening, and I know coworkers. Oh, I claim 9 all year long, and then in January or whatever in the month, I change it to 0, so I get a bigger return. Is this something like that, or is it not?
Something to that degree.
Okay.
Yeah, something to that degree. Not 100% all of it, but yes, it does something to do with that. Yeah.
Okay.
And so, you just got to make sure that you're doing it accurately. And that you're, because at the end of the day, again, this is your money, right? It's money that you're overpaying or that you're lending out to the government.
Yeah.
You're lending to the government.
You're lending to the government, period.
And they're making money off you.
Correct.
Of your money.
Correct.
All right.
So,
Killed this.
Last question for you, brother. So I know you said you're based out of Virginia, right?
Mm-hmm.
Let's say, even me, I'm a fan. Like from this day forward, I'm a fan.
I appreciate
it. I'm in a different state.
Okay.
Do I have to reach out to somebody like Justin, or can I reach out to a Justin that's in a different state?
No, you can reach out to a Justin that's in a different state as long as he's licensed in the state that you're in.
Okay.
So they can't reach out to you because you're based in Virginia?
No, they can reach out to me.
So if I live in New York, I can reach out to Justin?
Correct. Yep.
Okay.
Absolutely.
And you can make it happen.
Yep.
You're right. You're right on part, Lance. But I just want to ask you before you say that. 50 states could reach out to Justin.
50 states. I gotta check with California is always a little bit different.
Yeah,
so is California.
California.
I would say New York too. New York is different too.
New York and California.
New York is always a little bit different.
Right.
But I had enough due diligence to check on you guys in certain respects. So you guys.
Okay.
But yeah.
So let's say we're gonna go with 48 states can do it.
Right.
Can reach out to Justin.
For sure.
Well, how do they reach out to Justin?
So you can hit me up on LinkedIn. You can hit me up on Facebook, or you could just call me.
Can you share your handles?
Can we? What we'll do is we'll put your information on the comments below.
Okay.
And we're giving you some emails and stuff like that, so we could always get in touch with you.
You don't have like a Facebook or YouTube or Instagram that you want to shout out to, give somebody who's not going to look in the bio and the comments and all that good stuff?
Yeah. So my Instagram, let me see, man.
Let me scroll down here to see it. He about to call his kid. Hey, what's my Instagram?
Look, I'm looking at it right now. Like I'm not JP Trades on Instagram. I gotta change.
Can you spell that out?
Yeah, that's JPTRADEZ on Instagram.
Okay.
There you go. Listen, this is a lot of knowledge. You got another one? You want to say something?
So
okay.
Yeah, you can reach me out. You can hit me on Instagram. I got some content on there.
And we definitely covered the returns, right? The returns portion was the 6%.
Right.
Yeah, 6%.
Minimum 6%, and then obviously there's the ceiling is not 6%. That's the minimum. Okay.
Right.
That's right.
The last thing I'll say about this too, guys, is in terms of insurance is huge when it comes to protection, because, and I always like to give these two examples, right? Insurance, annuities, 7702 plans, all of those combined, they're non-attachable assets, right? And so what that means is that, if the Supreme Court, if the government can't get to these funds, you know, it's non-attachable. You know, two examples I like to give is everybody remember the Enron scandal.
Yep.
Right, Enron. So they can never get this money back because, you know, he put all of his money into annuity, which is a life insurance product, right? Everybody remember O.J. Simpson, the juice, right? So he lost his civil suit against the family of the victims, right? But guess what? They unfortunately were not able to get anything because, per his expert legal counsel, he moved to Florida and put all of his assets in an annuity, which is, again, a life insurance product. So life insurance, annuities, you know, they're non-attachable assets. And I'm talking about nothing can get to these things.
This is bulletproof. It's unreal.
Yep.
It's unreal. I know a little bit. I ain't know enough. I know that because I was taught something today. I think all three of us were taught something today.
Sure.
Speak for yourself. I
Yeah,
speak
I
to
know.
Justin on a one-on-one, brother.
I know. And about that 12 million, we're going to talk about that. But listen, we appreciate you, Justin. This is what I mean. We're very transparent with the people that watch us. And this here is probably the most transparent I've seen with someone when it comes to insurance. You know, I like I said, I hear a lot of snippets, you know, or buy this course and I'll show you how to be your own bank. I mean, you really, really gave them the sauce today. So, you know, and I can appreciate that. And we do appreciate you today, Justin. And once again, we'll put your information in. You gave out your information and, you know, best of luck to you. And we appreciate that. Definitely. Thank you.
Thank you, brother. I appreciate you. A lot of information.
Thank you.
That's right. H.G.R.G family. We got another one. We'll see you next episode. Appreciate you.
Yeah. What they say? I'm so divine. I'm so divine. Imperfection, perfection, my presence shines. My mental is parasailing maritime. They say I'm destined to read the palm line. Yeah, I'm so divine. I'm so divine. Imperfection, perfection, my presence shines.